Welcome to Property 118 TV, the channel dedicated to busting myths about landlord tax. In this episode, we're going to be looking at a structure that we call the capital account restructure. Now, this can be a little bit complicated, and I've explained it many times on Property 118 Tax. That's our website, property118.com/tax. But I thought I'd make a video about it as well, because this is really important for any property investment business that is looking to transfer their properties into a limited company, and especially for people that have decided to go and live outside of the UK. Now, I'm going to need to call up a manual from Hmrc's website again, one of their own internal manuals, to help explain this to you and to show you where to read more if this is a structure that you're looking to get into yourself. So if I just quickly share screens with you, you should be able to see the business income manual from Hmrc. So the business income manual, if you want to Google this, by the way, just type into a Google search BIM, short for business income manual, 45700. Now, I call it the capital account restructure. Hmrc refer to it as withdrawal of capital from business. And as we go through this, I think you'll start to understand the relevance of it. So I'll read a little bit from this manual, not all of it, but just the key points. It says, this chapter applies for income tax purposes to the computation of trade profits and property income. References in the text to a business should therefore be taken to include both trades and property businesses. So this does actually apply to what we're looking at here. This chapter does not apply for corporation tax purposes, where there are separate rules in the loan relationship legislation. So something completely separate. This is just for individuals, members of LLPs and partnerships. A proprietor of a business may withdraw the profits of the business and the capital they have introduced to the business, even though substitute funding then has to be provided by interest-bearing loans. So in other words, if you've got equity in your properties, or the property has retained profits, but there's no cash, you can actually go and borrow the money to withdraw your capital from the business. It goes on to say, the interest payable on the loan is an allowable deduction. Now, obviously, with that, you've got to also consider the restrictions on finance cost relief that apply to individual and private rental property owners from now on. It says, this is on the basis that the purpose of the additional borrowing is to provide working capital for the business. There will, though, be an interest restriction if the proprietor's capital account balance becomes overdrawn. So what does all that mean? Well, to understand this a little bit better, I think we need to have a look at one of the examples, and in particular, property related wise, example 2 of this manual gives us a great one to look at. It says, Mr. A owns a flat in central London, which he bought 10 years ago for £125,000. He has a mortgage of £80,000 on the property. He's been offered a job in Holland and is moving there to live and work. He intends to come back to the UK at some time. He decides to keep his flat and rent it out while he is away. His London flat now has a market value of £375,000. Now, the interesting point here, it shows the opening balance sheet with the mortgage of £80,000, but Hmrc accepts that as he's only just introducing this property into the business, that the opening market value for his balance sheet is the current value, not the £125,000 he paid for it. So they've got the £375,000 current value on his balance sheet. And if you deduct the market value of the property from the mortgage, you'll see that they're accepting that his capital account opening balance is £295,000. So he then renegotiates his mortgage on the flat to convert it to a buy-to-let mortgage and borrows a further £125,000. So bear in mind, he's now borrowing a total of £205,000, even though he only paid £125,000 for that property. he withdraws the 125,000, which he then uses to buy his flat in Rotterdam. So it then gives us an example of the balance sheet at the end of year one, showing that the mortgage is 205,000, the property at market value is 375,000. So his opening capital account balance was 295,000, less his drawings of 125,000. So he's still carrying forward £175,000 of capital account balance. Now, the great news about that is if he wanted to, and if it was possible to, he could actually go and take out a mortgage for the whole 375,000 and withdraw all of that cash, and he wouldn't pay any income tax on it because it's not deemed to be income. He's just withdrawing his own capital, and that's really important. It says, although he has withdrawn the capital from the business, the interest on the mortgage loan is allowable in full because it is funding the transfer of the property business at its open market value at the time the business is started. The capital account is not overdrawn. Now, obviously, as it said earlier, and I said earlier, and it was also stated in the manuals, we do have to bear in mind the restrictions on finance cost relief. But what Hmrc is saying is it can use all of that capital that's withdrawn out of the business, and you can still, obviously, even with the restrictions on finance cost relief, claim the 20% tax credit on those finance costs. Now, the reason this is important for landlords who are incorporating their business is if they haven't borrowed all of the capital that they've put into the property. So let's say they paid £1 million to buy their properties and they invested £500,000 of their own and borrowed the other £500,000. Doesn't matter what the properties are worth now, they could be worth 10 million. But that landlord can increase his debts from the 500,000 he's currently got up to the £500,000, by another £500,000. So he's borrowed the full £1 million that he invested into the property in the first place. So he can have and be sitting on that extra £500,000, £500,000 in cash in his bank account. He could then incorporate the business. The business would adopt that whole £1 million worth of debt. His equity that is built up, so let's say it is worth 10 million, so the £9 million worth of equity is built up, will be exchanged for shares, and the value of the shares can be offset against his capital gains. So effectively he rolls his capital gains into the value of those shares, and he doesn't pay any capital gains tax either. So he's still got £500,000 in the bank, and he can do whatever he likes with that. He can buy another house for himself. He can go and put it on a roulette wheel if he wants to, or buy a couple of Ferraris, or whatever he wants to do. Or alternatively, after incorporation, he might decide, well, do you know what? I'm going to pay this debt back. I'm going to put myself back into the position that I was before. So he repays £500,000. But the way he does that is he loans that money to his own company that he's just incorporated into. So the company now owes him £500,000. The company uses the money to repay the debt that it has adopted. So the company gets back to a position where he was in previously, where he's got only £500,000 worth of mortgages. And the benefit of doing this is that when the company then sells property, or if it makes profit, or if it wants to remortgage and he needs that cash out, then of course he can repay that loan he made to the company of £500,000 without paying any tax on that money. So it's a very, very tax efficient way of actually having your cake and eat it, if you like, because he's taking the cash out before he incorporates, lending it to the company, then repaying off the debt. So he hasn't got the servicing costs of the debt, but he has the ability to withdraw capital from his own company without having to pay tax on that capital. If he'd have simply not done this transaction, incorporated the business, then he'd have rolled all of his equity into shares, and the only real way of getting the money out of the company would be to sell his shares. So that might not be easy in a small privately owned company, If he was to have the cash in the company anyway, then if he draws that money out, then obviously he'd have to take it either as a salary or dividends, and that would be taxable. So it makes absolute sense for anybody who's looking to incorporate their business to check out whether this capital account restructure opportunity exists and to draw down as much cash as they can by increasing their mortgages to their base cost for capital gains tax purposes before you actually incorporate. Once you've incorporated, it's too late. So you need to do it before that. I hope you found that helpful. If you found that video useful, please leave a comment below to let me know. By all means, ask any questions and I'll try and cover those in another video or respond to your comment. Give us the thumbs up. That tells the YouTube algorithm that our channel is relevant, authoritative, and popular. And if you haven't already done so, you can subscribe by clicking the subscribe button, and then a little bell icon will appear to the right of that. When you click on the bell icon, YouTube will send you notifications as soon as we upload more content. If you'd like to see more about property118.com/tax, that's our website, property118.com/tax. Lots more information, lots more blogs. By all means, tune into the videos, but there are multiple ways of learning about tax. Hope you found that useful.